Hello, my name is Joe Hoyle, speaking to you from the University of Richmond, back to talk about Chapter 11 on intangible assets. When I was a student in college, intangible assets was a relatively minor topic in financial accounting. Businesses did not report many intangible assets. They tended to be expensed and not worried about. But over the years, there's become a greater appreciation of the intangible assets that companies do hold. Part of that is that technology has improved so radically, and that often creates intangible assets. We start by simply defining what we mean by intangible assets. An intangible asset is one that has a future value of over 1 year. It has a long life. It's used to generate revenue, but the asset itself has no physical substance. You can't touch it or kick it or something like that. Notice that except for the intangibility there, they're very much like property and equipment. The best examples are items like patents, copyrights, trademarks. Notice that these are where you have a legal right to something. For a patent, for example, you have a legal right to an invention. The basic accounting for intangible assets is very much like property and equipment. The intangible asset is recorded initially at cost, the normal and necessary amount to get it in condition and position to help generate revenues. That's the same. And in addition, that cost is written off to expense over the periods that it helps to generate revenue. Again, you can see the matching principle. For intangible assets, we often call that amortization rather than depreciation, but the process is still the same. However, typically, intangible assets are only depreciated on the straight line method. You don't see an accelerated depreciation nearly as much for an intangible asset as you do for property and equipment. There's one intangible asset I want to draw your attention to specially, and that is goodwill. I want you to look at goodwill for two reasons. One, on many balance sheets, it's a very large amount of money. Anything that is reported as a large amount is something that you should understand. And second, goodwill is an account that most people do not understand. I want you to understand what goodwill means. Goodwill that's reported on a balance sheet comes when one organization acquires control over another. Often that occurs by buying 100% of the outstanding voting stock. Once one company controls another, they produce consolidated financial statements. The two companies are put together. In putting the two companies together, you have to do something with the purchase price that the parent company paid. So what you do is you allocate that purchase price to the identifiable assets and liabilities of the new subsidiary based upon fair value. The accountant comes in, looks at the new subsidiary, and comes up with a value for each asset and each liability. The assets that are recorded are those that they have gained contractual rights to, or that can be separated from the subsidiary and sold. So land, buildings, and equipment that the subsidiary owns are now valued on the parent books and in consolidated statements at fair value. Most times, to buy a subsidiary, to buy a controlling interest in another company, you have to pay more than the individual fair value of those assets and liabilities. And the reason is that companies have a value as a going concern. They already have a reputation. They already have customers. They already have customer loyalty. Their employees already have a certain amount of knowledge. These are not assets in the traditional sense. But if you buy control of that company, you really do have to pay to get those attributes. So any extra that's paid to buy control over a subsidiary is allocated to the intangible asset goodwill. So if you look at a balance sheet and you see goodwill, you know that the parent bought one or more subsidiaries and paid in excess for the fair value of the assets and liabilities. Well, that's not an intangible asset like we're used to. What do you do with that? Well, you record that at the time of the takeover. But goodwill is no longer amortized. At one time it was, but now goodwill is not amortized. It can be a permanent asset. It could be on the books for 55 years for that matter. However, every year you do have to go in as the financial accounting and make sure that the goodwill has not been impaired. If it has, then it has to be written down. When we looked at property and equipment, we discussed the impairment of assets. Well, goodwill has its own particular process, and if that goodwill has been lost, if the value has gone down, then it has to be written down and a loss has to be recognized. So if you see goodwill, that's what you need to know to understand what the balance means. This chapter also talks about research and development costs. Research is anything you do to try to come up with new ideas. Development is anything that you do to take those new ideas and turn them into new products. We've often had discussions about how to account for research and development costs. And the reason is that there's such uncertainty. When you spend money on research and development, you really do not know whether you'll come up with something that has value or not. So the question has always been, because of that uncertainty, how do you account for research and development? In the United States, they have a set technique that everyone must use. And that is that all research and all development costs must be expensed as incurred. You cannot capitalize these expenditures. The reason is because of the uncertainty and the possibility that the company might manipulate their reporting. So whether you're in California or Maine or Florida, when you have research and development costs, they must be reported as expenses immediately. So again, if you pick up a set of financial statements and you look on the income statement and you see research and development, then you know that's the total amount that was spent this year by that company to try to come up with new ideas and turn those new ideas into new products. This chapter closes with a discussion of present value. You will see present value again when we cover bonds payable, but I think that will make more sense if you introduced or get introduced to present value here in our discussion of intangible assets. The idea behind present value is that if you have a contractual future cash flow, how do you value it? For example, if you buy a patent and agree to pay $100,000 in 5 years, that's a future cash flow. How do you value that future cash flow? Well, here's the basic idea. If there's also going to be paid a reasonable interest rate, for example, you agree to pay $100,000 for a patent in 5 years, but in the interim, you're going to pay 6% per year in interest, and that 6% is a reasonable amount, then you do not need present value. The $100,000 is simply valued at $100,000. If you have a future cash flow, but you're paying a reasonable amount of interest on that future cash flow, then present value is not needed. The patent in this case is recorded at $100,000, and the liability is also recorded at $100,000. But present value becomes relevant when you have a future cash flow, but a reasonable amount of interest is not being paid. Then, how do you value that contractual cash flow? For example, let's assume that you buy a patent for $100,000 to be paid in 5 years. but no interest is to be paid in the interim. That is not a reasonable rate of interest. When that happens, you take the cash flows and you find their present value. In simple terms, what that means is you take those cash flows and you pull out a reasonable amount of interest and assume that the rest of the amount is what the cash flows are worth. You take the future cash flows, you find the present value. When you find the present value, that pulls out a reasonable interest rate. What is left is the value of those cash flows. So for example, if you buy a patent for $100,000 and you're going to pay in 5 years, but you're not paying a reasonable interest in the interim period of time, then find the present value, and when you do that, let's assume it's $83,000. Then that is the value of the cash flows. That is the amount that you're paying for the patent. Record the patent at $83,000, record the liability at $83,000, and then you have to record a reasonable interest for that 5-year period of time. To find the present value, you need 3 things. You need to know the number of time periods. In this case, it was 5. You need to know a reasonable interest. Let's assume it was 6%. And you need to know whether the cash flows was a single payment amount or an annuity. Now, a single payment is obviously one amount paid at one time. An annuity is an equal payment at equal time intervals. So $10,000 per year for 5 years is an annuity. $900 a month for 2 years is an annuity because it's an equal time payment at equal time intervals. Find the present value, and that's what you record the cash flows at the beginning, because it's pulled out a reasonable interest rate. Chapter 11 talks about intangible assets, how they're reported, how they're amortized, and we look especially at goodwill, where does it come from and how do you account for it, research and development, what are you paying for and how is it accounted, and present value, finding the present value of a contractually set future cash flow by taking out the reasonable amount of interest. Chapter 11 has a lot of interesting things. At least to me, it's a whole lot more interesting than when I took this course a few years ago. Study hard, read Chapter 11, watch for these things.